some of the easy pushback and why we're not hyper concerned with autos here currently is in most of these instances in terms of credit leverage, you need labor to really crack before these things roll over. Yes, they can be under pressure. Yes, they can be going the wrong way. Yes, they're notable and it's something to monitor. Yeah. But it's not. A lot of these things aren't really going to metastasize and kind of crescendo until you see labor roll over. If you still have your job, you're still getting paid. You know, this thing isn't going to totally break down.
That's a good point. And as long as credit's being extended,
right?
Like on the margin being extended more than like I guess you're gonna take out credit and buy stuff with it.
Right. Yeah, exactly.
That's the assumption.
And so here, this chart is just showing the annual run in jobless claims. We're down another 1,000, I think, in the latest print this morning. But we're running at the lowest level since 1973. So on the separation side of the labor market, we're just not seeing the weakness yet. And at least for the next couple months, we see on the hiring side, we think you see an acceleration. So that's going to flow through positively to income growth. So, those are the two sides. No weakness yet on the separation side, and we think there's going to be incremental strength on the hiring side. So labor is still relatively strong. And then the last chart here, autos, you can just eyeball it, but you can see autos are typically a mid-cycle phenomenon. It varies, but mid-ish cycle, you can call it. So it's not it's not this acute harbinger of weakness or cycle rollover risk.
Yeah.
And it's also remember, auto sales are part of that consumer credit data. So if it peaks mid-cycle and rolls, it's not unexpected that it would emerge as a drag on continued acceleration in total consumer credit, which is one of the other reasons we look at the trend in revolving credit growth to see kind of where the state of domestic consumers lies. So if we kind of wrap this up in terms of how it flows through and manifests in this kind of self-reinforcing fashion, if we assume supply up or demand down or both, you end up seeing used and off-lease inventory increase. With that supply increase, you see prices go down. Prices going down equals higher lease costs for consumers because residual values are going down, plus lower trade-in values and rising negative equity in new car loans, which equates to higher costs. Higher costs equals an incremental drag on demand. Demand down equals prices and dealer incentivizing. Prices down, dealer incentivizing up, and on you go.
Yeah.
So
straightforward.
It's kind of an auto-specific version of that first flow chart we showed.